Hello, future business administrators. Welcome to Anu's classroom. So, today we are going to talk about financial accounting. Okay, and when you talk about financial accounting, what is the first thing that comes into your mind? It is definitely debits, credits, and bookkeeping, journal entering, ledgering, cash books, right? Profit and loss, balance of accounts, all those things. Now, if you are from a commerce background, you might be already familiar with these concepts and how to write journals and all these things. So um, but if you're not from a commerce background, maybe you are from a technical background, so you might have some difficulty to actually pinpoint from which is a debit account, which is a credit account and all, especially when you're writing journals, ledgers and all. So in this video I will tell you how to get this debit and credit accounts right in your books of accounts. You know what is a book of account, right? A book of account is nothing but a book which has all your accounts and transactions recorded in it. So that is, we will employ one rule, just one rule that you need to remember, and you will be done with it. Right now, what is happening when we take any normal book, okay, a study guide or your textbook, you will have the traditional rules and you will have the modern American standard of approach, and all these things, it will become very difficult for you guys to keep track of it, right? Most of the people find a little bit difficulty in keeping track of whether it is a personal account or a real account or a nominal account, or is it an asset or a liability. And if it and once I find out what it is, now should I increase credit or should I decrease debit, what it is to be done, it is very confusing for most people, right? But a few people, definitely it comes naturally. Now if we are not in that set of people who get it naturally, what do we do? Well, in this video I'll give you a secret tip, okay, to always get it right. But make sure you stick around till the end of the video to know what that secret tip is. So in every transaction, you will have two accounts. Every financial transaction will involve two accounts, because when we talk about journals or ledgers or whatever it is, we are talking about the double entry system of credits and debits. So an account from where money goes will have a corresponding account where money is going from. So it is like, you can think of it like this, okay? Money is neither created nor destroyed. Money is neither created nor destroyed. This is also true, okay? It's not just energy that is neither created nor destroyed. Now, but it flows from one account to another. This is the this is a very important concept that you have to always make sure. So if from somewhere an account has an inflow of money, that means from somewhere that money is getting reduced, and that may be inside your business or from outside your business. And if money is going out of your business, then somewhere that money is becoming more, okay? So that is the most important thing that we have to make sure. And we are doing the books of accounts, we are doing the bookkeeping for our business, so our focus should mainly be on the business aspect of it. We need to find out whether money is coming in or going out from our business, and the corresponding other account will definitely be the opposite, correct? So one of them will see an outflow of cash and the other will see an inflow of cash, okay? That means one of them will be debited and the other will be credited. Easy enough, right? Okay. Now, a transaction can be of two types, okay? It could either be a debit transaction or it could be a credit transaction. What is a debit transaction? Well, you can think of debits as destinations of money. When money is debited from me, the destination has an increase in money. Like for example, if you take bank account, okay, you have a bank account. Now, and this is you, okay? Now, if you do a debit transaction, that is, you pull in money, you are the destination for the money. So in your hand, the money increases. In your bank's account, the money decreases, okay? Now, what is a credit transaction? So over here, what we are talking about was the money you have put in bank, okay? It is not bank's money, but it is your money with the bank which you're pulling out. And that is also important. It is your money with the bank that you're pulling out. Now, Another transaction is a credit transaction. Credit is a source of funds. Credit is source of funds or source of money. Suppose you pull in a loan from a bank. Again, what is involved? Account involved is again bank and you, but this is a loan. Okay, and if it is a loan, that means you are taking bank's money, and so you are liable to pay bank. Bank becomes a liability for you. If you are the business, then in this transaction the bank becomes a liability for you. Now in case of other than bank, if you have taken from any creditor, then also what happens is that the transaction is actually causing you a liability. Okay, so that is also understood, right? In case you are not understanding anything, feel free to stop, pause the video, go back and start again. Okay, now we need to find out, given a statement, a transaction statement, we need to find out what kind of a transaction is happening. Is it a debit transaction or a credit transaction? Now, how do we find that out? We need to look at what exactly is happening in that transaction when it comes to business. Okay, when cash flows in and out of business due to either a creation or a reduction of an asset, like for example you are buying or selling a building or furniture or the goods. Okay, maybe you are purchasing goods from outside, or maybe you are selling your products. Okay, that is a creation or reduction of an asset. Now, creation of an expense, like for example you're giving out rent or wage or purchase, you're purchasing something, then that is an expense for you. Okay, that is a creation of expense. So money in such transactions usually flows out of the business. And then suppose you, and then there's one other case that is like a special expense. For example, sales returned, you sold something, so that was a source of revenue for you, but now that good is coming back, so your revenue is decreasing. That is, it is like you now you have to pay the money which you had with you back, right? Whatever money you got initially, now a small portion of it you're having to give back. So it is kind of like a small expense for me, a special kind of expense for me. So that is also a type of debit transaction. So next we'll talk about credit transactions. When can you say that the transaction that is given to you is a credit transaction? For that, we should know what is the reason for the cash flowing in or out of the business. Is it because you did a sale and you got a revenue out of it, or you got some commission or some interest for your investment, like that? So if this is the reason why cash has come in, then it is a credit transaction. Or maybe you took a loan, or you paid back some amount loan. Okay, that is creation or reduction of a liability. Then also it is a credit transaction. Or maybe you did some purchase, okay, but then you returned it. That is a special kind of revenue. It is not actually revenue, but you're getting money because whatever you purchased you returned. So that is also, you should think of it as a credit transaction. Okay, so why we are classifying like this is for our ease of understanding how to write the journal entries. Okay, that is the reason why we are classifying it like this. We are trying to understand the type of transaction that is happening. Now this is the rule. Okay, if it is a credit transaction, then there will be one particular account which is making it a credit transaction. Like for example, there is a capital account involved, or maybe there is a what you can say, there is a sales account involved. So some account where the capital is involved, right? So the account whose value increases should be credited. Credit transaction, increase in value, you should credit that account. And if the account's value is decreasing, you should debit it. This is for your credit type of transactions wherein money is flowing in and out due to liabilities or revenues or equity. Suppose you found out that your transaction is a debit transaction, then the account whose value increased should be debited. See, debit transaction, increasing value, debit. And if the account whose value is decreasing, it should be credited, just the opposite. So first find out credit transaction or debit transaction. If it is a credit transaction, the account's value which is increasing should be credited. If it is a debit transaction, the account whose value is increasing should be debited. Simple enough, right? That is the rule. That is the only thing that you have to remember. Now, let us put it into practice. How do we put it into practice? First step, we need to identify the accounts which are involved in the transaction. Then we will identify what type of transaction it is, whether it is a debit or a credit, and find out which value is increasing and which value is decreasing, and we will apply the rule. That is it. If it is a credit transaction, account whose values increases, it will be credited. The one which is decreasing will be debited. If it is a debit transaction, account whose value is increasing, we will debit it, otherwise we will credit it. This is how we will go on. Now, let us put them into practice, how we will find it out. Now, example, I commenced business with capital. Step 1, we have to identify the accounts involved. When we say commenced business with capital, definitely one account is capital account. So the other must be cash account. So the two accounts, cash and capital. What type of a transaction is this? It is when somebody starts a business with capital. For the business, that person is a liability. And liability is a credit transaction. So I identified credit transaction. Which account's value increased? The capital account's value increased, right? The value in capital account increased because of my transaction. So the account whose value increased is capital. So naturally, the value of the account whose value decreased will be the cash account, because that is the only two accounts involved in the transaction. Now, what is the rule? For a credit transaction, the account whose value is increasing, we have to credit it, and the other one should be debited. So cash and capital will credit, cash so automatically will debit. Easy? Found the rule? Now, let's go and look at another example. Purchased goods. When we say purchased goods, it means we are purchasing it with cash. But suppose if it is purchased good from some person, then we generally think of it as a credit transaction. Okay, so we'll see the difference. Why? So now nothing else is given, just purchased goods is mentioned, no person is mentioned. Okay, so we'll think of it as a cash transaction. You have given cash and you have purchased goods. From whom? It doesn't matter, because I have given cash. So the two accounts, one is purchase account, the other is cash account. Identified the two accounts. Now, what type of a transaction is this? This is a debit transaction. Why? Because when I'm purchasing goods with cash, my asset is increasing, right? Or you can think of it like my expense increased, right? I gave money out to purchase goods, and that purchasing got me assets. So this is a debit type of transaction. Which account's value increased? The purchase account, right? Our assets represented by purchase account value increased. Which account's value decreased? Naturally, cash account. Now, what is the rule? Debit the account whose value is increased, because it is a debit transaction. And whichever is decreasing, we will credit. So purchase account debit, cash account credit. Okay, now we'll see the next one. Purchased goods from Vijay. Now I have purchased goods from Vijay. It is not mentioned that I am purchasing it with cash. So we will assume that this is a credit transaction. Otherwise, Vijay, we don't need that name Vijay. So Vijay is involved. So what are the two accounts? One is definitely purchase account, the other is Vijay's account. What is this type of transaction? Purchasing goods from someone is asset creation, or you can say an expense is created, right? So it is a debit transaction. Whose value increased? When I purchased, my value increased, right? My purchase account's value increased because I purchased. So naturally, Vijay's account decreased. So what is the rule? If it is a debit transaction, whichever account's value increased, we will debit, the other one we will credit. Now, you can also think of it like a liability. Why? If you think of it as a liability creation, because we are doing it in a credit, I am liable to pay Vijay, right? I am liable to pay Vijay. When you think in that angle, my liability to Vijay increased. Okay, my liability to Vijay increased. So, when I look from a liability angle, which account's value increased? Vijay's account's value increased. So if I am thinking from that angle and I am thinking of it as a credit transaction, then according to my credit transaction rule, whichever value increased, I have to credit, and the other one will be debit. So again, if I think of this transaction as a liability creating credit transaction, then also I will credit Vijay's account and debit purchase account. That is what is happening here. So you see, when you look from a debit angle or a credit angle, you should identify which account is it that you are thinking of when you are saying that it is a credit transaction. When a liability is formed, then that I am liable to which account? That is what is increasing. But if I am thinking it of an asset creation or an expense creation, what is the reason? Which account is the reason my expense increased? that will be debited. So this is how we apply this rule. Okay. Now, when I think about sold goods for cash, again, so what is happening? Whatever is with me, I had created a few products in my inventory, it was there. Now I am selling it. When I sell it, what is happening? What is going to happen? I'm going to get revenue. So the two accounts, sales account and cash account. What is happening? I am getting revenue. So it is a credit transaction. This is a source of fund for me. So which account's value increased? My sales account's value increased, right? I did sales. So my sales increased. So it is a sales account whose value increased. So naturally the opposite account's value should decrease. So what is the rule for credit transaction? Whichever account is responsible for the credit transaction, if its value is increasing, I'll credit it. The other one naturally becomes debited. So sales credited, cash debited. Okay. Next one, paid to Santosh. Now, again, this is a statement which we can look at from two different angles. The first angle, when you say that you're paying to Santosh, so it might be because I owed Santosh money. Okay. So Santosh was a liability to me. Now I am paying up that liability, meaning my liability towards Santosh through this transaction I am decreasing. You can think of it like that. That is a credit transaction. So definitely the two accounts involved will be paid to. That means I might have paid to Santosh using cash, so cash account and Santosh's account. Now if I think of it as a liability reduction, I am paying it so that my liability towards Santosh is reducing. Then my liability to Santosh decreased. So this is the thing. My liability to Santosh decreased. According to my credit transaction rule, if the account's value increases, I will credit. But if it decreases, I am supposed to debit. So if my liability towards Santosh decreased, that means my liability towards Santosh in Santosh's account decreased. So and I'm thinking of it as a credit transaction, means Santosh's account has to be debited. So naturally the other one will be credited. So that is why you can see over here, Santosh debited and cash credited. This is one way of looking at this transaction. Now, another way. Suppose say I am giving money to Santosh. Okay. I am giving money out of my pocket to Santosh, but Santosh is supposed to pay me back. I am acting like a creditor to Santosh now. Okay. That means whatever money I am giving to Santosh, he owes me that money back. Okay. So that means I am creating an asset with Santosh. In that case also the two accounts involved is cash and Santosh. Now, when you think of it as an asset creation or an expense creation, then what is happening? The money which Santosh owes me is increasing. Right? So, if you think of it as a debit transaction, whichever account's value is increasing has to be debited and the opposite one should be credited. So, whatever I have given to Santosh's liability towards me. Okay. Santosh is liable to pay me back. Santosh owes me more money now because I have given him money. So again, Santosh's account, so according to debit transaction rule, Santosh's account will be debited and cash account will be credited. So whether you think of it as a debit transaction or a credit transaction, finally, if you can choose the right account, if you can spot the right account and the right movement of money in that account, whether it is increasing or decreasing, then you will be arriving at the same result here without having to think of many rules. Like you don't have to think of whether it is a real account or a nominal account or nothing like that. Okay. Now the other one, next one is deposited in a bank. If I go and deposit money in my bank, that means I might be depositing in my maybe my SB account or my current account. So it is an asset for me. What I'm creating here is an asset. Otherwise, the statement would read like repaid loan to bank. Then at that time it is a liability reduction. But this is not that transaction. Here I'm saying I've deposited money in bank. So definitely cash and bank are the two accounts. It is an asset creation for me. So it is a debit transaction. Now, whose value increased? Whatever bank is holding for me increased. So bank is the account whose value increased. Naturally, the other one will be cash. Now, what is the rule? Debit the account whose value increased, credit if it is decreasing. Then bank debit, cash credit. Now, withdrew from bank, the next one. Now what is happening? When I am withdrawing money from bank, then naturally what is happening is, it is a source of fund for me. There's no liability created because whatever I'm withdrawing from bank is my money only. Okay. So even though it is a source of fund to me, it is essentially a source which is reducing my asset capability. My asset is decreasing here. Okay, so that's why it becomes a debit transaction. Because whatever money was in my bank, when I withdraw it, though my business is getting money, essentially it's saying that my asset, I had an asset with the bank whose value is decreasing. So according to debit transaction, if the account which makes it a debit transaction, if the value in that account is decreasing, then I have to credit. If it is increasing, I have to debit. But if it decreasing, then I have to credit. That means bank account has to be credited. Naturally, the other account involved will have to be debited. Fine, right? You're able to pick it up. I hope you're able to pick it up. Now, the other one, selling furniture. When you buy furniture, you're creating an asset. Just like withdrawing from bank was a reduction in your asset, selling furniture was your business's asset. Selling furniture is an asset reduction. Yes, money is flowing into your business, but the reason why money is flowing into your business is because you have sold your asset. Okay, your asset decreased. So it is a debit transaction. So two accounts involved, cash and furniture. Whose value decreased? Furniture's. It is a debit transaction. Furniture reduced means furniture should be credited and cash should be debited. Now, how am I, you might be now wondering, like, how can I say that asset reduced is debit transaction, or maybe revenue generated is a credit transaction, and this kind of selling furniture to get money is not a credit transaction? Well, that is the reason why I told you stick with me to the end. We are nearing it. I'll tell you that secret tip which I use to spot these kinds of patterns. Okay, now return goods to Vijay. I bought something from Vijay. Now I'm returning it. That is, in a way, I had an expense, but that expense is now a little less, right? So it's kind of like you can think of it as a special kind of a revenue that is created. It's not a revenue. Whatever I had given, now I'm getting a portion back of it because I'm returning the goods. Okay, so two accounts. One is Vijay, the other is purchases returns account. Purchases returns is the account where we mention all the money which we are getting because of a return we are doing for the purchased goods. Okay, that is why we are telling of it as a special revenue getting created, because in purchases account money will only come into it. It will not go out of a purchases account, returns account. If money is going out because of a goods purchase, it will be from a purchase account. But if money is flowing in because of a purchase, then it is a purchases returns account. So from purchases return account, money will only flow in. It will not flow out. And from a purchase account, money will never flow in. Money will always flow out only. Okay, so you should be thinking of this as a credit transaction. Whose value increased? Purchases returns value increased. And naturally, the other one, it's not cash, it is Vijay. Vijay's account's value naturally decreased. So if it is a credit transaction, who credit the account whose values increased, and debit the account whose value decreased. Whose value increased? Purchase return. So credit purchase return. Whose value decreased? Vijay. So debit Vijay. Again, sales return to Mohan. Now what is happening? I did a sale to Mohan, but he is returning that to me. So that is, now whatever money I got from Mohan, I have to give it back. So it is a special kind of an expense that is being created. And just like how sales will always have money flowing in because it is a revenue, sales return will always be an expense. Why? Because from sales returns, money will only flow out. Okay, so two accounts involved. One is Mohan, the other is sales return. This is a debit transaction. Whose value increased? My sales returns value increased. And naturally, Mohan's account value decreased. For a debit transaction, whichever account's value is increasing, we'll debit it, and the other one will credit it. So sales return is debited, Mohan is credited. Again, this is another type of transaction you will find in the questions. Withdrew cash for personal use. Now, when I withdraw something, whether it be cash or goods or whatever it is from the company for personal use. Personal use means it is not for the employee's personal use. Okay, when we are talking about personal use, the personal use is of the owner. What happens is that a temporary account called a drawing account, we will not directly write it down as a capital reduction. Okay, we will think of it as a drawing account. So because by the year end, if the owner is putting the money back, then essentially my net capital will remain the same. But if he is not, then at the end of the financial year, we will transfer whatever drawing was there to the capital account. Okay, so if it is a if the owner has took money out and did not pay back, then naturally we'll mark it as a reduction in the liability towards that owner because he has already taken that money. Okay, so in such cases, a drawing account comes into picture. So the personal use account is a drawing account, and withdrew cash means the other account which is involved is naturally cash. So what is it? For me as a business, it is an expense. It is a debit transaction. Which account's value increased? The drawing account. That person, the owner has drawn account money from the business. So his account's value increased. So naturally cash decreased. Let's apply if we apply the rule for the debit transaction, we'll find out that the drawings account should be debited and the cash account credited. Similar to this is the goods taken away for personal use. So when goods taken away means goods and taken away. That means something was purchased for the business, but then the owner took it away for personal use. So in this case, the two accounts which are involved, definitely one is drawings, the other one is purchases. Again, this is an expense for me. So it is a debit transaction. Drawing account value increased because he took out of it. And naturally purchases, whatever I had purchased, it is decreased now because the owner took it out, drew it for personal use. Debit transaction, apply the debit transaction rule. Then we'll see that drawings debited and purchases credited. Similar to this is the withdrew from bank for personal use. The accounts involved will be bank and drawings. It is an asset reduction or an expense creation. It is a debit transaction. Again, whose value increased? The drawings account. Whose value decreased? The bank account. So apply the rule for debit transaction. Debit the account whose value increased and credit whatever decreased. Drawings is debited and bank is credited. So now, how am I finding out whether it is a debit transaction or credit transaction? Based on the type of cash flow, the type of accounts involved, right? That is the secret tip. Now, I'll tell you what the secret tip. This is what you have to remember. This word, dealer. Okay, if you remember this word dealer, you will be easily able to spot it out. Now, what is dealer? Well, dealer is actually is actually an acronym for dividends, expenses, assets, liability, equity, and revenue. Dividends, expense, and assets. If our transaction involves a creation of an expense, asset, or dividend, or a reduction thereby, it is a debit transaction. And if the transaction creates or reduces a liability, equity, or revenue, it is a credit transaction. That is all that you have to remember. Now, if you go and apply this rule, if you can find out what is getting affected, is it the dividend, expense, or assets, or the liability, equity, or revenue? Now, if you go and check on it and try to apply our rule for debit transaction, credit transaction, I guarantee you, you will never get it wrong. For example, see over here, salary paid. When you hire a person, you are liable to pay salary at the end of the month, right? So at the beginning of every month, a liability is created for the business to pay that person at the end of the month. Now, when you actually finally decide to pay it, you are having a reduction in that liability. Your liability towards your employee is reducing. So what type of transaction will it be? It is a liability reduction credit transaction. Now, whose value increased? Or you can say whose value decreased better, because it is a liability reduction. It will be easy to spot the account whose value reduced. Whose value reduced? The salary payable or your salary account, that liability in your salary account is what decreased. So, what is our rule? If it is increasing, credit transaction, increasing means credit, decreasing means debit. Which account will I debit down? My salary account. So, naturally, the other account involved in the transaction has to be credited. Okay, so I hope this video was useful to you in finding out. I know it is not something that will come naturally to you. Okay, it will take practice, but jot down those important points. Okay, like how to find the credit transaction or debit transaction, how to find out the account involved, and how to understand what is meant by that transaction line. Okay, if you can spot that and write down our rule for a debit transaction: increase debit, decrease credit. Credit transaction, increase credit, decrease debit. That is it. Okay, write these down, take a problem and try to solve it. I'm sure that you will be able to properly write down your journal entries and thereby your ledger entries in one single go. Okay, so I hope this video was useful to you. If it was, if this helped you in any way to make your bookkeeping entries, writing bookkeeping entries easier for you, consider subscribing, consider sharing this video with your friends so that you can pass this knowledge on. Okay, thank you so much and have a great day, have a great learning time ahead. And I hope to see you all in my classes